Hi everyone, Value Add Mike here today to discuss how I think multifamily will react during the next recession. For those who don't know, my name is Value Add Mike Taravella, and I've closed over $65 million in commercial real estate with my partners in multifamily. I've been getting asked a ton of questions from investors of should I wait, when's the dip, buy the dip in commercial real estate, specifically in multifamily. And I think it's super important to understand why I think multifamily is a more resilient industry compared to the other sectors like single family homes and other sectors of the market. And I think the first things first, when I'm talking to investors and they're waiting for the dip, they're waiting for these distressed assets. And to be honest, in multifamily, yes, there's going to be cases in which people are distressed. But looking at this report from Fannie Mae, they're a lender within the industry, and you can see here, during 2008, 2009, we had a 1.6% default rate on loans. So if you think about all of the commercial real estate, less than 2% of commercial real estate assets were in default. That doesn't mean that it's perfect. It doesn't mean it's resilient 100%. But when you buy in good assets in good markets that show growth, it'll allow you to really hone in, understand the market. So I tell investors all the time, we don't see as many distressed assets. Yes, there's neglected ones at best, but it's super important that you know if you're waiting for the dip or the crash, the 2008, 2009 recession, that distressed investor may not be there when looking at investments. Another reason why I think multifamily will do well during the next recession is because even though we've had historic rent growth due to the inflation and everything else in demand here in the Southeast, I think another reason that I think waiting for the dip is a terrible idea, the dip, if you will, is because rent growth. I think during 2008, 2009, because you've heard countless stories of people losing their homes, their jobs, and etc. But really, when it comes to rent growth, worst case, we see that rent goes generally flat or a little bit dip, but there's no huge catastrophic dip. So looking at Fred, the financial reserve, it puts out a ton of amazing reports, and you can see here, and it continues to grow and scale. In 2008, expenditure for renters was $33,984, and it only dipped down to $33,400 and $460. So that just goes to show that the rent, in the worst case, given everything happened that 2008, 2009, the worst case is that rent dipped a little bit. And you can see here it quickly rebounded and it continues to grow. Here's the historic growth to 46,000, but we're in a slight dip right now. So if it's super important when you're looking at these things that you understand that there isn't a ton of defaults when looking at multifamily, and there isn't a huge rent decline, but more a flat rent. So what does that mean for an investor? I think number one, it's super important that you can never time the market. COVID and everything else happened. You always have to be looking for deals. So for you as a passive investor, I think it's super critical that you recalibrate your criteria, really look in for what you're looking for on an investment, and stick the number. If the offering that you have doesn't quite hit it, don't force yourself into a deal because there could be opportunities in the near future. But keep always networking and operating and never sit on the sideline. And two, I think another thing that's super critical when looking at the assumptions on deals is that you want to make sure that you're playing defense with your underwriting. So not assuming crazy rent growth or and just really dialing in your expenses because we're in this inflationary time, and just making sure that your operators are underwriting in that same assumption. So if you found any value in this video, please like, comment, subscribe. And if you want to get more information regarding investing alongside Niche Holdings and myself, please click on the link below, and we'll look forward to you next week.